Most people think markets move because of news. A war starts somewhere, metals go up. Tensions cool down, metals fall back. That's the story we hear again and again. But markets rarely behave that neatly. Sometimes a signal isn't in the headline at all. Sometimes a signal appears when the market refuses to react the way everyone expects. That's what caught my attention this week. There was news suggesting the situation in the Middle East might stabilize sooner than originally anticipated. In theory, that kind of development usually reduces the urgency for safe haven assets like gold and silver. Yet silver moved higher anyway. Not quietly either. It was one of the stronger single-day moves the market has seen in months. When that kind of mismatch appears, when price action doesn't follow the narrative, it usually means something else is influencing the market behind the scenes. Not necessarily something dramatic, but something the majority of people simply aren't paying attention to yet. And that's often where the real information sits. So before jumping to conclusions about where prices might go next, it helps to step back and look carefully at what actually happened in the market. No predictions yet, just the observable facts. Let's start with what actually happened in the market. At the beginning of the latest trading session, silver opened at approximately $83.65 per ounce. Over the course of the day, the price moved higher, briefly reaching just under $90 intraday before pulling back slightly. Compared with the previous Friday's close near $82.91, that represents a move of roughly $6 within a single session, or slightly more than 7%. Gold also moved higher during the same period, although the magnitude was smaller. The metal rose about $63 from the prior close, trading around $5,238 per ounce at the time the market data was recorded. While both metals advanced, silver's percentage gain was significantly larger than gold's. At the same time, broader financial indicators showed relatively modest movement. The US dollar index, DXY, traded around 98.79, down from approximately 99.68 the day before. That represents a moderate pullback in the dollar. Meanwhile, the 10-year US Treasury yield remained near 4.14%, showing little change during the same session. Market volatility also eased slightly. The VIX index, which reflects expected volatility in US equities, declined from roughly 29.49 to about 25.5. Beyond price movements, several exchange data points provide additional context for the metals market. According to exchange reports, COMEX registered silver inventories currently stand near 81.7 million ounces. Registered inventory represents the portion of metal stored in exchange vaults that is available for delivery against futures contracts. Outside the United States, the Shanghai Futures Exchange reported silver inventories declining from roughly 559 tons in November to around 381 tons by February, representing a decrease of approximately 43%. At the same time, spot premiums for silver in Shanghai have remained elevated, indicating that physical buyers in that market are willing to pay above futures prices to obtain immediate delivery. Those are the measurable developments currently shaping the market environment. No conclusions yet, just the observable data. Price movements in precious metals rarely come from a single factor. Most of the time, several forces interact at once: currencies, interest rates, industrial demand, and investor positioning. When silver moves faster than gold in a short period of time, analysts usually look for differences in what is driving each metal. Gold tends to function primarily as a monetary asset. Its price often responds to changes in real interest rates, currency movements, and central bank activity. Silver operates slightly differently. It shares some of gold's monetary characteristics, but it also has a significant industrial role. Silver is widely used in technologies such as solar panels, electronics, semiconductors, and certain components used in electric vehicles. According to reports from the Silver Institute, industrial applications have accounted for more than half of global silver demand in recent years, with solar photovoltaic manufacturing representing one of the fastest growing segments. Because of that dual role, silver sometimes reacts not only to monetary conditions, but also to expectations about manufacturing activity and energy transition infrastructure. Currency movements can also influence metals markets. Precious metals are typically priced in US dollars. When the dollar weakens even modestly, metals priced in dollars can become more accessible for buyers in other currencies. This dynamic can support demand in international markets. Interest rates form another layer of influence. Precious metals do not generate yield. As a result, when real interest rates rise significantly, holding metals can become relatively less attractive compared with interest-bearing assets. When rates stabilize or move lower, that relative disadvantage can diminish. Positioning in derivatives markets may also contribute to short-term price changes. Commodity futures markets include hedgers, institutional investors, and short-term traders. When prices rise quickly, traders who previously sold futures contracts may choose to close those positions by buying contracts back. That process, often referred to as short covering, can add additional upward momentum to prices during rapid moves. None of these factors on its own determines the long-term direction of the market, but together they help explain how metals prices can move quickly even when a single headline, such as geopolitical news, suggests a different immediate reaction. Looking at those relationships allows investors to understand the mechanics behind the price movement rather than reacting solely to daily news cycles. Silver has a long history of moving more sharply than gold during certain periods of the market cycle. That characteristic isn't new, and it's largely tied to the structure of the silver market itself. Compared with gold, the total value of the silver market is smaller. Because of that, changes in investor flows or industrial demand can sometimes produce larger percentage moves in price. Similar dynamics have appeared before. During the commodity cycle of the early 2000s, silver experienced periods where it rose faster than gold as investment demand for precious metals expanded globally. That environment was shaped by aggressive monetary easing following the global financial crisis, which increased interest in assets perceived as stores of value. Another example occurred during parts of the 2020 to 2021 market period, when pandemic-related disruptions and stimulus policies influenced both inflation expectations and commodity demand. During that time, silver also experienced periods of higher volatility relative to gold. However, while those earlier environments share some similarities, today's market also contains several important differences. One key difference involves the scale of industrial demand linked to energy transition technologies. Solar photovoltaic manufacturing has become one of the largest sources of silver consumption. According to the International Energy Agency, IEA, global solar capacity expansion has accelerated significantly over the past decade, increasing demand for metals used in photovoltaic production. Another difference involves central bank behavior in the gold market. Data published by the World Gold Council shows that central banks have increased their gold purchases in recent years, adding to official reserves as part of broader reserve diversification strategies. While those purchases directly affect gold rather than silver, shifts in central bank reserve behavior can influence sentiment across the broader precious metals complex. Finally, the structure of global supply chains has evolved. Manufacturing demand for electronics, semiconductors, and renewable energy systems has expanded, which indirectly affects silver consumption because of the metal's role in conductive materials. History provides useful reference points, but it rarely repeats itself in identical form. What it can do, however, is help investors recognize patterns in how metals markets respond when monetary conditions, industrial demand, and investor positioning begin to interact at the same time. When markets move quickly, the temptation is to assume the direction will simply continue. Professional analysis usually takes a different approach. Instead of assuming certainty, it helps to outline a few possible paths and think about the conditions that would support each one. Right now, there are three broad scenarios worth considering. Bull case, continued strength. For silver to continue moving higher in a sustained way, several conditions would likely need to remain in place. First, the US dollar would need to remain stable or weaken further. Because precious metals are priced globally in dollars, a softer dollar can make metals more attractive to international buyers. Second, real interest rates would need to remain contained. If inflation remains elevated while nominal interest rates stabilize, the real yield environment can remain supportive for metals. Third, industrial demand would need to remain steady. As mentioned earlier, silver is used extensively in solar energy technology and electronics manufacturing. Continued expansion in those sectors would help maintain underlying demand. Under these conditions, stable currency markets, manageable real yields, and ongoing industrial consumption, silver could maintain upward momentum over time. However, even in this scenario, markets rarely move in a straight line. Periods of consolidation are common after rapid price increases. Base case, stabilization, and range formation. The more common outcome after a sharp move is a period of stabilization. In this scenario, prices do not necessarily collapse or surge higher immediately. Instead, the market spends time digesting the recent move. That often involves sideways trading within a defined range, while investors reassess macroeconomic conditions. Several developments could support this type of environment. If the US dollar stabilizes rather than weakening further, and if Treasury yields remain relatively steady, the metals market may lose the immediate catalyst that drove the most recent move. At the same time, physical demand from industrial users and investors could continue to provide a floor under the market, limiting the extent of any downside movement. In that environment, prices may fluctuate within a narrower band while traders wait for new information, such as updated inflation data, central bank guidance, or shifts in global manufacturing activity. Historically, many commodity markets move through these consolidation phases before the next directional trend develops. Bear case to is conditions shift. A different outcome could develop if several macro conditions change simultaneously. One key factor would be a stronger US dollar. If the dollar index were to rise meaningfully, metals priced in dollars could face additional pressure from currency dynamics alone. Another factor would be rising real interest rates. If inflation data were to cool more quickly than expected while nominal yields remain elevated, real yields could increase. Historically, rising real yields have tended to create a less supportive environment for precious metals. A third element involves investor positioning. If speculative positioning becomes heavily concentrated after a sharp move, even modest shifts in sentiment can sometimes lead to short-term corrections as traders reduce exposure. In that environment, silver could experience a pullback while the market rebalances. The key point is that markets rarely follow a single script. Each of these scenarios depends on a different combination of currency trends, interest rate dynamics, and industrial demand conditions. Thinking in probabilities rather than certainties helps investors remain flexible as new data emerges. When markets move quickly, it's easy to focus only on the price chart of a single asset. In practice, experienced analysts tend to watch several indicators at the same time to understand the broader environment surrounding that price movement. One of the first indicators I monitor is the US dollar index, DXY. Because precious metals are priced globally in dollars, currency fluctuations can have a meaningful influence on demand. If the dollar strengthens significantly, metals often face additional pressure as they become more expensive for buyers using other currencies. On the other hand, if the dollar weakens or stabilizes, that currency headwind may ease. The second indicator is U.S. Treasury yields, particularly the 10-year yield. Treasury yields provide insight into how investors are pricing economic growth and inflation expectations. Changes in yields also influence real interest rates, which can affect the relative attractiveness of non-yielding assets such as gold and silver. Inflation data is another key variable. Reports such as the Consumer Price Index, CPI, and the Personal Consumption Expenditures Index, PCE, are closely followed by financial markets because they influence expectations about monetary policy decisions by the U.S. Federal Reserve. Unexpected changes in inflation data can shift expectations about interest rates, which in turn affects precious metals markets. Beyond macroeconomic indicators, I also watch market structure data. This includes futures open interest, which reflects the total number of outstanding contracts in the market. Changes in open interest can provide clues about whether price moves are being driven by new positions entering the market or by existing positions being closed. Liquidity and trading volume also matter. Higher trading volume during price movements can indicate stronger participation across the market. None of these indicators provides a complete answer on its own, but together they help create a clearer picture of how different forces, currency markets, interest rates, inflation expectations, and market positioning are interacting around the metals market at any given moment. Markets rarely move in a perfectly predictable way. What we've seen recently in silver is a meaningful price move, supported by a combination of currency dynamics, industrial demand, and positioning within the futures market. But like any market development, it's only one piece of a much larger picture. That's why it's important to stay focused on the underlying indicators rather than reacting to every headline or short-term price swing. The dollar, interest rates, inflation data, and physical demand will continue to shape the environment for precious metals over time. Watching those factors carefully often provides more useful insight than trying to guess the next daily move. As always, uncertainty is part of financial markets. Patience and risk management tend to matter more than short-term predictions. This isn't investment advice. It's simply how I'm reading the market right now.